Hello everyone, and thank you for joining us today. My name is Dan Pybus, a director in our London transfer pricing team, specializing in financial transactions. Welcome to our episode regarding the guarantees section of the OECD discussion draft on financial transactions. This forms part of a 5-part series covering different aspects of the paper. I'm here today with Jeff Rogers, a transfer pricing partner in our PwC Canada office that specializes in financial transactions. So Jeff, to begin with, perhaps I could ask you, how well does the discussion draft describe the function of guarantees in an intragroup context?
Well, Dan, guarantees are one of those transactions that are fundamentally simple, but they can become complex very quickly. The guarantee fee section in the discussion draft is the shortest section. It's only 4 pages. Having said that, it's really well written, but it's not exhaustive. The discussion draft does a very good job generally discussing financial guarantees in the related party context, but anyone looking for guidance on operating or performance guarantees are going to be a little bit disappointed. Now, the guarantees that the discussion draft review are mainly those financial guarantees that produce a rate benefit or a quantum benefit, which is a little bit surprising given the emphasis throughout that we've got on accurate delineation, options realistically available, and considering both sides to the transaction. So the one scenario that I was surprised to see left out is that scenario where a lender requires the guarantee for the transaction to happen and how to evaluate a transaction with that particular facts and circumstance.
Okay, thanks, Jeff. And just building on that, does the additional clarity around implicit versus explicit guarantees help taxpayers and tax authorities, or does it add additional uncertainty?
Dan, you're referring to paragraphs 142 to 144. And I think broadly they are helpful for taxpayers. And for us, it really formalizes what we've been doing in practice for quite some time, where we consider the full spectrum of guarantees from a legally enforceable explicit guarantee to the other end of the spectrum where we might have a letter of comfort that's been provided that is not particularly legally enforceable. And then you layer on the transfer pricing guarantee, which is the implicit guarantee, just recognizing that a multinational group will intervene to the extent it can to support a subsidiary in the event of financial duress. So that recognition of implicit support is very much consistent with that in the prior Action 8 to 10 paper, which is now the revised OECD guidelines, and quite frankly, what we've been living with in Canada since the GE Capital case decisions in December 2009, which was reaffirmed by the Federal Court of Appeal in December 2010. What is also helpful in these paragraphs is the OECD actually goes and considers a scenario where you have an explicit guarantee that might not actually be worth anything. Now, consider an overall group banking arrangement. You might have a scenario where a subsidiary is able to borrow from a multinational bank in that subsidiary's country, even though it's negotiated at the parent company level. There may be cross-default provisions in that facility in the form of covenants. And if that were the case, there may be an event where a subsidiary defaults on its own obligation, which means the overall group has defaulted on its obligations, which means the explicit guarantees themselves, if they're provided from parent down to sub, they may not actually be worth anything because the covenants effectively mean that the entire group is in default on this facility. That, I thought, was a helpful example that will help taxpayers and advisors alike review in more detail the third-party banking facilities. I think what was also helpful was there's a great paragraph in there on cross-guarantees. Now, cross-guarantees have always been one of those transactions that they're extremely difficult to evaluate. It requires taking a look at a multinational group and figuring out who's contributing what from an earnings and assets perspective, trying to figure out what this contribution could look like in the future, and potentially figuring out who should pay what for the guarantee and what they're contributing. And the OECD effectively gives us an out evaluating those kind of transactions, recognizing that it's a lot of work, it's incredibly complicated, and we may not actually be able to identify what the compensable benefit might be if there is one. So I thought that was very helpful to give a practical solution to a very complex problem.
Okay, I think I've got 2 follow-up questions in relation to your response there. My first, builds on GE Capital case, and I know the US and Canadian tax authorities know that case very well. What key learnings have been reflected in the paper, and which areas do we think still need a bit more guidance in the discussion draft?
I think the discussion draft does a good job summarizing what the judge really had to get his head around and how to evaluate the guarantee. Having said that, I think I would have gone a step further if I were the OECD, and I think I would have been a little bit more explicit in the steps to evaluate the guarantees. Now, the ingredients are there, but for a topic that is generally complicated, I think there's a real good opportunity to provide additional guidance to taxpayers. And that additional guidance might look something like this. Step 1 in evaluating a guarantee. What is the purpose of this guarantee? What happens if the guarantee is removed? Does the guarantee itself produce a compensable benefit? Those are really key questions that would be undertaken as part of a functional analysis for guarantees in identifying whether you actually have a transaction that has produced a compensable benefit. And it gets into the banking agreement issue that we talked about with your previous question. Step number 2. What are the appropriate methods to value the guarantee from both the lender and the borrower perspective? And we see that construct a lot in this discussion draft. Evaluate both sides of the transaction. So again, we're consistent with prior sections of the draft, but here we're articulating a key step 2 to evaluating guarantees. Lastly, step 3. What is the range of values appropriate to price the transaction? When evaluating guarantees, we know that there's 2 sides to this transaction, so there must be 2 prices for this transaction. And I think that's probably why we end up using 2 different methods to price guarantees in most of the cases when we evaluate them in a related party context.
Thanks, Jeff. So you've mentioned a kind of 3-step approach there for analyzing guarantees, and one step within that is the pricing. And that builds nicely into my second follow-up question from before, which is, how well have the OECD captured the key methods for pricing guarantees?
The OECD articulated 4 pricing methods to price intercompany guarantees. These are the CUP method, the yield approach, the cost approach, and the valuation of expected loss approach. And I'll talk about those in a second, but I think there's actually a 5th approach, which may be an unspecified approach, and that might be, for example, if you had a guarantee where there was a quantum benefit associated with it. Depending on the industry and the 3-step approach I mentioned earlier, you may actually be able to use standby letters of credit or letters of credits to come up with a range of arm's length guarantee fee prices with the appropriate adjustments. So I think there could have been that 5th method there. Now, the other point I would add is inherent in all of the methods that the OECD talks about is that there is no market to actually conclude that these are arm's length prices. So these are all very much theoretical constructs where we're trying to produce an arm's length results for transactions that most often in the transfer pricing world, well, entirely in the transfer pricing world, are going to be between related parties for which there's no active market to observe what the pricing on guarantees would be. So the OECD recognizes that the CUP approach is not easy, which is very consistent with our experience as transfer pricing advisors. They go through the construct of how you might apply the yield approach, and I think that's generally consistent with how evaluated the guarantee from a cost-benefit perspective in the GE Capital case, and in fact, that's how the treasurer evaluated the pricing of the guarantee in the GE Capital case. The cost approach evaluated by the OECD is very much as it sounds. What is the cost to the guarantor? And they look at it a few different ways, but ultimately they're getting at what the expected loss would be to the guarantor, which is very consistent with the 3rd method they go through, the evaluation of the expected loss approach, which would essentially be what would the guarantor lose in the event that the guarantee is actually realized, and what should be the expected return on that loss. And then lastly is a method that's not very often used in practice. It's a very cumbersome method in some respects, and that's the capital support method. So this is a very theoretical method, and what it would involve is basically if you have a guarantor that would be rated BBB, for example, and another one that would be rated B, the approach basically goes through and says, how much capital would need to be injected in that balance sheet of that B-rated recipient of the guarantee to get them up to the same credit rating as the guarantor. And then basically you'd figure out that amount of capital, and then you'd assign a return to that capital. And that would be the price of the guarantee that would get paid to the guarantor.
So you spent a fair bit of time talking about the theoretical side of things, Jeff. And I guess some clients might be wondering from a practical point of view, what should they be doing now, and what would our recommendations be reflecting on this paper?
I think the key takeaway from this section of the discussion draft is that the OECD has finally put together guidance on how to evaluate guarantees. We've been waiting for this guidance for quite some time, and certainly it's been that area of transfer pricing where many times it has not been addressed. And I think now that it is highlighted in this discussion draft and we've got that guidance, I think we now have to address guarantees in perhaps a level of detail that we may not have gone into before, recognizing that the OECD is getting into the banking agreements themselves and identifying whether there's truly value to some of these guarantees. So I think might have previously been on the list to deal with, but we're going to leave it. We're not going to put a lot of time into it because it's a difficult issue to deal with. I think it's now time to take it off that too hard list, and it's time to deal with these issues and take a position.
Okay, so final question, Jeff. What is the longer-term direction here of travel from the OECD? And which areas do we expect will remain in the final consensus version?
Well, Dan, I think the way this paper is written, I think it leaves a little bit to interpretation in some of the sections. But I think ultimately, if taxpayers are able to put together a position that considers capital market principles in each of these sections, from treasury functions, guarantees, captive insurance, and these positions consider implicit support and how these transactions could be considered in a broader multinational enterprise context, I think we're able to get to a position that makes sense from a taxpayer perspective. And I think the OECD, despite how certain sections of discussion draft are worded, I think ultimately that's the direction where they will find consensus, where they are able to point to capital market transactions and say this is how things are done in the real world. I think that may be a safe place for the OECD to land, and oftentimes that's where taxpayers, that's how they price their intercompany transactions.
Perfect. Thank you, Jeff, and thank you all for your time today. Please look out for the other episodes in this 5-part series, which will cover interest rate pricing, captives, cash pooling, and delineation.